But the thing is, we've gone through 50 and the buying, if anything, has increased. And the risk here is that the chart goes parabolic. And the blood in the water that the sharks smell is that there's not enough supply, and that that they can break these markets. So when I say break the markets, you've got too many longs demanding delivery, and there's not enough supply. And we're going to find out that both gold and silver have been fractional reserve markets where they counted on only 1 or 2 or 3% of the longs standing for delivery. I think there's a real shortage. Actually, I know there's a real shortage. I mean, just look at what's going on in London. They're scrambling to be able to make deliveries. And it's just so important that people understand that if silver fails to deliver within 72 hours, you're not going to see markets open.
Silver is flashing signals of stress that the global financial system can no longer afford to dismiss. Bill Holter, a well-known precious metals analyst, has warned that the current silver market is under unprecedented strain. India has doubled its imports in terms of ounces, while Chinese dealers have largely pulled back from selling altogether. In fact, the few dealers still offering silver are charging extraordinary premiums, sometimes as high as $128 per ounce. Holter also pointed to silver's move into backwardation, where spot prices exceed futures, and the dramatic spike in lease rates, both of which highlight a shortage so severe it threatens the system's variability to deliver physical metal. Looking back at history, Holter drew comparisons with silver's two major runs to $50 in 1980 and 2011. In both cases, the spikes were short-lived, quickly reversed, and never held long enough to fundamentally change the market structure. This time, however, he emphasized that the setup is completely different. Silver has broken through the $50 mark and managed to hold above it for more than a week, with buying momentum only growing stronger. Looking ahead, Holter argued that silver should be viewed not only as an investment but as practical protection in the event of a market breakdown. Gold may remain the ultimate store of wealth, but silver's smaller units make it far more usable for everyday transactions. In his view, if global markets were to seize up, there would be no monetary asset more valuable to hold in hand than silver, second only to food and basic self-defense. If you found this video helpful, don't forget to like, share, and subscribe to stay updated. We'll continue delivering sharp insights and expert perspectives on the forces driving gold, silver, and the broader financial landscape. Thanks for watching.
I was going to say we can start with silver because that's where the financial system very well could end, is with silver. There's obviously huge tightness all over the world in silver. India has doubled the amount of ounces. Forget about dollars or rupees. They've doubled the amount of ounces they're importing. The bullion dealers in China have basically closed down and they're not selling silver. The one bullion dealer that is selling silver is selling it at $128 an ounce. Silver's gone into backwardation where the futures or where cash is higher than the futures. The lease rates have exploded. It's primed and set up for failure to deliver. And I can't stress enough how important it is for silver not to fail to deliver, because if it does, it'll immediately spill over to gold. And you get action in gold like we're seeing in silver, that's the end of the system. And I say the end of the system because confidence will entirely break. And the fractional reserve / fiat system runs 100% on confidence. And if you break confidence, and it goes back to what my late partner Jim Sinclair used to say, what is the value of a contract that cannot perform? And the answer is zero. And he posited that you could see gold futures at $10 offered, no bids, and $50,000 bid and no offers. Meaning people will not accept contracts because they know they're not going to perform. They want the real deal in their hands. And things, obviously, because we live in a computer age, things happen so much faster, than they did 40, 50 years ago. And we should talk a little bit about the two spikes in silver that we had previously to $50. 1980 with the Hunt brothers, and then 2011. The Hunt brothers, that was if you want to say that was vapor at the end. I mean, there was a huge spike. It was basically an intraday spike, or within a week's period of time. They did not stay at $50 for any real length of time. And then again, the same thing happened in 2011. We had the spike up. It didn't go through 50. It fell back, and then they smashed it. And of course, they smashed it in 1988 also. This time, I know it's not good to say this time it's different, but it is different. It's already different. You can see it. We've been over $50 now for what, a week? Maybe a week and a half. But the thing is, we've gone through 50, and the buying, if anything, has increased. And the risk here is that the chart goes parabolic. And the blood in the water that the sharks smell is that there's not enough supply, and that that they can break these markets. So when I say break the markets, you've got too many longs demanding delivery, and there's not enough supply. And we're going to find out that both gold and silver have been fractional reserve markets where they counted on only 1 or 2 or 3% of the longs standing for delivery. It's been a process. This has been taking place for 2 or 3 years now. So no longer can you count on first notice day being a big number and that's going to shrink from there. What's happening is buyers are set up. They're buying that month contract and saying, I want delivery. So they're piling up now. They're forming a line, if you will.
Wow.
It's a bank run into gold and silver, and that's what's going on with COMEX. Yeah, you're seeing lines all over the place. I mean, how is it that other than possibly the government telling them don't sell any silver, we want to portray a shortage, but I don't think that's the case. I think there's a real shortage. Actually, I know there's a real shortage. I mean, just look at what's going on in London. They're scrambling to be able to make deliveries. And it's just so important that people understand that if silver fails to deliver within 72 hours, you're not going to see markets open. Markets across the globe will not be able to open, in my opinion, within 72 hours. I think that's not really the right way to look at it. It shouldn't be concerning if you're sitting on silver and markets close. I can't think of another asset that I want to have in my hands other than a loaded gun and food. I cannot think of any monetary asset that I would want in my hands other than silver if markets close. And I'm not dissing gold. Gold is for, that's your store of wealth, but you're not going to trade in gold. I mean, you're going to have a hard time with silver eagles or 1 ounce bars or 1 ounce rounds, silver rounds. You're going to have a problem getting change back. I mean, if you deal with a farmer and let's say you want 2 dozen eggs, how are you can't get change back, but a silver dime will do it.
Bill Holter argued that gold has been deliberately suppressed because it poses the greatest challenge to fiat currencies such as the dollar, euro, pound, and yen. He maintained that if left to trade freely, gold would not have stalled near $1,900 to $2,000, but instead surged much higher, potentially $4,000, $6,000, $7,000, or even $8,000 an ounce. Silver, being a far smaller and thinner market, has faced even greater manipulation, since any breakout in silver prices would inevitably pull gold higher alongside it. Once gold moves significantly upward, Holter warned, confidence in the entire paper-based financial system begins to unravel. Looking forward, Holter suggested that China could one day reset the global standard by pegging gold at $50,000 an ounce and offering to buy or sell unlimited quantities at that level. Such a move would instantly draw global money flows toward China, away from Western pricing, and force a repricing across world markets. The problem, he emphasized, is that a jump of this magnitude would destroy the existing contract system, as counterparties would be unable to meet obligations under such a massive revaluation. In his view, this kind of repricing wouldn't just shake the system, it could break it entirely. Let's get back to the interview.
Let me just mention this because I've got a bunch of emails in the last 3 or 4 days. Uh, the wholesalers have really pulled their bids back on junk silver. Junk silver now, if you're going to sell it, you're looking at $2.50 or $3 below spot. The only silver above spot in North America are silver eagles. I think they're about like $1 over spot. But people are concerned that, oh my gosh, I'm not going to be able to sell my silver. Well, understand that when all this silver that's been sold, all this junk silver, that's been melted down. And of course, they've not made any silver dimes or quarters since 1964. So there is no more supply, and the supply that has existed, any of that that's being sold, if you're selling it at $2 or $3 under spot, I guarantee you your wholesaler is sending that to a refinery and just picking up the 3, 4, 5% VIG and putting that in their pocket. Understand that can't go on forever. And also, there are refiners now saying they're not accepting any more silver because they've been inundated, and it's a physical process. It's not like pressing a computer key and boom, it's done. They actually have to refine it out. They've got to refine the 10% copper out if they want to get it to 99.99 pure.
Yeah.
So while right now it feels a little bit, maybe did I make a mistake buying junk silver? No. If you wait a month, 2 months, 3 months, and this is assuming the system continues and does not collapse, in the future, in my opinion, junk silver is going to end up holding the highest premium of any form of silver in North America because the supply is being wiped out whenever anybody sells it. It's being destroyed. It's being melted down. Well, first off, that will bleed over to gold, and gold will also fail to deliver. Understand that gold and silver have been suppressed. The prices have been suppressed literally for 50 years, since 1976 when they started with futures and options on metals. Understand that gold has been suppressed because it is the direct competitor to fiat currencies, whether it's the dollar, the pound, the euro, the yen, whatever fiat currency, gold is the direct competitor. Now, if let's say 10 years ago, gold didn't stop, or 15 years ago, gold didn't stop at the $1,900, $2,000 level, and it blew through, and it got to 4,000 like we are now, and then it moved to 6, 7, 8,000, and started spiking. What that tells you is it's not gold going up; it's the fiat currency that's losing value. So it's important to understand that silver being such a small market, it's been very easy to manipulate. And they had to manipulate silver harder than gold because if silver ever got on hand, then gold goes. And if gold goes, then you have confidence breaking. Yeah, if markets stayed open, of course, the markets will level out. What will happen is they'll find a medium, and if China doesn't bend, and this is something my late partner Jim Sinclair used to talk about. He said he could foresee the day where China would say, okay, gold's $50,000 an ounce. It's bid at 50,000. It's offered at 50,000. What do you want to do? So if they peg the price or set the price at $50,000 or in yuan or whatever, but equivalent of $50,000, then what is the price worldwide? It's got to be $50,000 because that's the market. I mean, money is going to flow where it's treated best. And if the West is at $4,000 gold or $5,000 gold, and China's buying it and selling it in whatever quantities you want at $50,000, that then becomes the price. The problem with that is if you jacked up gold prices 12-fold from here, or it wouldn't even have to go 12-fold, it could go less than 100% from here to break. that would break the contracts. That would break the market itself, because like I said, for every winner, there's a loser. And can somebody lose 12 times their money and stay solvent? No, they can't pay the winner. Then the winner's a loser. And then the people who are doing business with either the winner or the loser knows they're both dead. You're going to do business with them? You're going to trade with them? No. And that's what I mean, I'm not looking at this and saying, I think this is what could happen. This already happened.
The unfolding dynamic in gold and silver highlights a fragile system stretched to its limits. Years of price suppression, fractional reserve practices, and reliance on confidence rather than true delivery have left the markets vulnerable to a breaking point. With silver showing signs of real shortages and the potential for delivery failure, the risk extends directly into gold, where any sustained surge would expose the weakness of fiat currencies themselves. If delivery cannot be met, or if external forces like China reprice gold dramatically higher, the consequences would ripple across global finance, shattering trust in contracts and undermining the very foundation of modern markets. If gold and silver deliveries fail, how can governments restore market confidence? So, stay tuned for clear, data-driven insights into the financial system. Don't forget to like and subscribe so you never miss our weekly updates. Thank you for your continued support, and we hope you enjoy the video.